Last year, a retired school teacher named Margaret walked into a financial advisor's office. She had $500,000 saved for retirement. The advisor was warm, confident, and recommended a conservative portfolio of mutual funds and annuities. What he didn't tell her was that he would earn over $25,000 in commissions just from selling her those products, and that the funds had expense ratios 4 times higher than identical alternatives that would have saved her over $10,000 a year. 2 years later, Margaret's portfolio had barely grown. When she questioned the advisor, he said, "The market has been volatile." What he didn't say was that nearly half her returns had been eaten by fees and commissions. Margaret didn't know she had a choice. She didn't know that financial advisor isn't a protected term. Anyone can use it. And she didn't know that there's a small, powerful group of advisors who are legally required to put her interests first, who don't take commissions, and who would have saved her over $100,000 over the next decade. If you stay until the end of this video, you'll learn exactly how to find a fee-only fiduciary advisor, the only type of advisor who is legally required to put your interests first 100% of the time. I'll show you the 3 compensation models, the 1 question that exposes conflicts of interest, and the step-by-step process to vet anyone who calls themselves a financial advisor. You'll never be the Margaret in that story again. My name is your name, and today we're going to protect you from the financial advisors who are actually salespeople in disguise. Before we go any further, I need to make an important confession. The term financial advisor means almost nothing. It is not a legally protected title. Anyone, a stockbroker, an insurance agent, a banker, a CFP professional, can call themselves a financial advisor. It's like coach or consultant. It describes a role, not a standard of care. When you hear that term, your mind likely conjures a person with a degree, a license, and a legal duty to help you. That is a dangerous assumption. According to the SEC, there are over 650 Zero-Zen registered investment advisor representatives in the U.S., plus hundreds of thousands more who are not registered as fiduciaries, and they all call themselves financial advisors. Most of them are governed by a standard called suitability, not a fiduciary duty, and the difference between those 2 words can cost you hundreds of thousands of dollars over your lifetime. Asterisk Part 1. The vocabulary of trust. What do these words actually mean? Let me define 3 key terms before we go any further. These will be the foundation of everything you learn today. Fee-only advisors receive compensation solely from their clients. That may include a flat planning fee, an hourly fee, a subscription fee, or a percentage of assets under management, AUM. They do not earn commissions from investment products or insurance sales. For consumers, this structure is generally viewed as easier to understand. You pay the advisor directly, and no third party compensates them for their recommendations. Many fee-only advisors register as investment advisor representatives and operate under a fiduciary standard, meaning they must put the client's interests ahead of their own when providing advice. Fee-based advisors may charge planning or asset-based fees, but can also earn commissions from selling certain products, such as insurance or annuities. From a consumer's perspective, this hybrid model requires closer scrutiny. Some recommendations may fall under a fiduciary obligation, while others may follow a different standard depending on the advisor's role at the time. Regulators allow this structure, but they require disclosure. The key is that when a fee-based advisor puts on their insurance agent hat, they are no longer a fiduciary. Commission-based advisors earn their income entirely from commissions on products they sell. Mutual funds, annuities, insurance policies, and other financial products. Under the suitability standard, which governs many broker-dealer relationships regulated by FINRA, an advisor only needs to recommend products that are appropriate for the client's general situation. A suitable recommendation can be more expensive, less tax efficient, or less optimal than alternatives, as long as it is not wholly inappropriate. Here's the difference laid out clearly. A fee-only fiduciary must put your interests first, disclose all conflicts, and seek the best possible outcome for you. A fee-based advisor may wear multiple hats, sometimes a fiduciary, sometimes a salesperson. A commission-based advisor is generally a salesperson held to a standard that only requires their recommendation not be terrible. The difference between in the client's interest and suitable can cost an entrepreneur hundreds of thousands of dollars over a career. Part 2. The suitability standard. How just good enough is costing you a fortune. The suitability standard is the legal floor for many financial professionals, particularly those who work for brokerage firms. Under FINRA Rule 2111, a broker must have a reasonable basis to believe a recommendation is suitable based on a client's investment profile, things like age, income, risk tolerance, and financial goals. But here's the catch. Suitable does not mean best. A broker can recommend a mutual fund with a 1.2% expense ratio when a functionally identical index fund charges 0.03%, provided the more expensive fund is suitable for your profile and the conflict is disclosed. Under the fiduciary standard, that same recommendation would likely violate the advisor's duty because a materially lower cost equivalent exists. Let me give you an analogy that makes this crystal clear. Imagine you need a new car and you walk into a Ford dealership. You describe your needs: good gas mileage, reliability, all-wheel drive, and those needs are best met by a Toyota Highlander. Under the suitability standard, the Ford dealer could say, "A Ford Explorer would meet all your needs. We have those right over here." The dealer makes the sale and gets the commission. You have a car that is suitable, but it isn't what's best for you, and you have no idea you were steered wrong. Under the fiduciary standard, the dealer would be legally obligated to say, "You just described a Toyota Highlander. We don't sell those. You would have to go down the street to Toyota. I can sell you a Ford Explorer, but it's more expensive and it's not exactly what you need." Most financial advisors operating under the suitability standard are the Ford dealer. They can only sell you the products their firm offers. They may recommend a variable annuity with a 7% commission because that's what their firm sells, not because it's the best product for you. They may steer you into a high-fee managed account because their firm gets a revenue-sharing payment from the fund company. Under suitability, this is perfectly legal. Under a fiduciary standard, it is not. The research from the Council of Economic Advisors estimated that conflicted advice costs American investors approximately $17 billion per year in aggregate. That's not a rounding error. That's a tax on trust. Part 3, the fiduciary standard, the gold standard of financial advice. Asterisk. The fiduciary standard is a legal obligation that requires a financial advisor to act in the client's interest, placing the client's needs above the advisor's own compensation, firm revenue, or product preferences. Under the Investment Advisors Act of 1940, advisors registered with the SEC must put the client's financial well-being ahead of their own compensation, their firm's revenue targets, and any product preferences or sales incentives. This standard represents the highest duty of care in the financial services industry. A fiduciary must do several things. They must disclose all material conflicts of interest through SEC Form ADV Part 2A, the firm's brochure. They must recommend the lowest cost option when equivalent alternatives exist. They must document that their recommendations serve the client's interest, and they must act with both duty of care, understanding your financial goals and applying diligence, and duty of loyalty, which involves avoiding conflicts of interest. The SEC's Division of Examinations has made fiduciary duty compliance a core theme for 2026, emphasizing that advisors must at all times serve the best interests of their clients and eliminate or fully disclose all conflicts of interest. The SEC also announced 2 enforcement actions against advisory firms that failed to provide clear disclosure around conflicts of interest tied to fee-based managed account programs. The message from regulators is clear. They are watching, but here's the problem. Not everyone who calls themselves a fiduciary actually is. Some advisors may claim to be fiduciaries, but operate under a suitability standard for part of their business. Some may be registered as investment advisors, but still earn commissions through affiliated insurance or brokerage arms. The CFP board has required all certified financial planner professionals to act as fiduciaries at all times when providing financial advice. However, not all advisors are CFPs. And as of a few years ago, only about 15% of CFPs were fee-only. The rest earned at least some compensation through commissions. That's changing, but it means you cannot assume a CFP is automatically putting your interests first. Part 4. The hidden dangers of commission-based advisors. Real stories, real harm. Asterisk. Let me give you real examples of what happens when conflicted advice goes wrong. In 2023, a stifle broker generated almost $122,000 in excessive commissions by trading accounts of 19 customers, 13 of whom were seniors. He placed trades in new commission-based accounts when those trades should have been executed in existing fee-based accounts where the clients would not have paid any commissions. FINRA found that he did not have a reasonable basis to believe that paying more for the stocks was in the customer's best interests. The firm reimbursed the clients, but only after the harm was done. This is not an isolated incident. According to a recent study by the SEC, conflicts of interest, such as sales contests and commission-based compensation, can lead to unsuitable investment recommendations and potential harm. When financial advisors earn commissions for selling specific products, they may prioritize recommending products that earn them higher commissions rather than those best suited for the client's needs. This dynamic leads to unsuitable product recommendations, excessive fees, and missed opportunities for better investment strategies. The most common claims in FINRA arbitration are customer suitability claims, where investors allege that their financial advisor recommended investments that were inappropriate for their situation. These cases often involve seniors who were placed in high-risk or illiquid investments, or investors who were churned, excessively traded to generate commissions. I've seen this happen personally. A client of mine, a widow in her 60s, was sold a variable annuity by a commission-based advisor who told her it was safe and guaranteed. What the advisor didn't tell her was that the annuity had a 7% surrender charge, meaning if she needed her money before the 7-year surrender period ended, she would lose 7% of her principal. She also didn't know that the annuity had annual fees of over 3% and that a simple CD ladder or bond portfolio would have given her similar safety with 0 fees. She lost over $30 Zuzen before she came to me. The lesson here is brutal but simple. When someone gets paid a commission to sell you something, they are a salesperson. A salesperson's loyalty is to their commission, not to you. That doesn't make them evil. It makes them human, but you need to know which hat they're wearing. Part 5, 2026 Regulatory Landscape. What you need to know this year. Asterisk. The regulatory environment for financial advisors in 2026 is complex and evolving. Let me give you the current state of play. Regulation Best Interest, Reg BI, which took effect in June 2020, requires brokers-dealers to act in the best interest of retail customers when recommending securities transactions or investment strategies involving securities. However, Reg BI is not a fiduciary standard. Under Reg BI, a broker-dealer must act in the best interest of the retail customer at the time a recommendation is made, without placing the broker's interest ahead of the customer's interest. This is a higher standard than the old suitability rule, but it falls short of the full fiduciary duty that applies to investment advisors. The Department of Labor reinstated its original 5-part fiduciary test for determining investment advice fiduciary status under ERISA in March 2026. This means that financial professionals who provide advice on retirement accounts like 401(n)(a)s and IRAs may be subject to fiduciary standards depending on the nature of their advice. Meanwhile, the SEC's 2026 examination priorities continue to emphasize fiduciary duty compliance, identification and mitigation of conflicts of interest, transparency, and robust disclosures. The division will focus on advisors' adherence to fiduciary standards of conduct, particularly advice to retail investors. What does this mean for you? It means that some advisors are subject to higher standards than others. It means the rules are not uniform. And it means you cannot rely on the government to protect you. You need to protect yourself by asking the right questions. Part 6. How to find a fee-only fiduciary advisor, your step-by-step action plan. Now that you understand the landscape, let me give you a practical, step-by-step process to find and vet a fee-only fiduciary advisor. Step 1. Know what you're looking for. You want an advisor who is fee-only and a fiduciary. Fee-only means they are compensated solely by clients. No commissions, no kickbacks, no referral fees. Fiduciary means they are legally required to put your interests first. The National Association of Personal Financial Advisors, NAPF, has 4,500 fee-only fiduciary financial planners who meet this standard. Step 2. Use the right search tools. Asterisk. Here are the best resources to find fee-only fiduciaries. NAPFA's website offers a directory of fee-only fiduciary financial planners who have met rigorous standards. Every advisor listed must be a Certified Financial Plan or CFP and sign a strict annual fiduciary oath. For high net worth individuals or those wanting the strictest vetting, this is the Ivy League directory. The XY Planning Network is best for Gen X and Millennials, particularly if you have student loans, equity compensation, or are looking to buy your first home. XYPN popularized the monthly retainer model, typically $200, $500 a month for ongoing planning. Their advisors are younger, tech-forward, and almost exclusively virtual. The Garrett Planning Network is best for hourly advice, perfect if you're a do-it-yourself investor who just wants a checkup on your 401(n) allocations or a second opinion. You pay for the time you use, nothing more. The CFP Board's website allows you to search for advisors by location and specialty. However, keep in mind that not all CFPs are fee-only, so further research is required. For our UK viewers, look for independent financial advisors who are fee-only and regulated by the Financial Conduct Authority. The FCA has a directory of advisors. Many UK advisors are fee-based, meaning they charge a percentage of assets, not commissions. The term independent means they must consider products across the whole market. For Canadian viewers, the money sense. Find a Qualified Advisor tool allows you to search for advisors by qualifications, location, services, specializations, and payment model. Look for advice-only planners who charge fees for financial planning advice, not percentage of assets. In Canada, the fiduciary standard is not as clearly defined as in the US, but advice only is a good starting point. For Australian viewers, look for fee-for-service financial advisors. Since the Royal Commission into Misconduct in Banking, Australia has significantly tightened regulations. Advisors must act in the client's best interest, and conflicted remuneration commissions is banned on most product advice. Step 3. Interview multiple advisors. Once you have a list of 3 to 5 candidates, interview each one. Ask these critical questions. Question 1. Are you a fiduciary 100% of the time? If they say usually or in certain contexts, walk away. The correct answer is yes at all times. Question 2. How are you compensated? You want to hear fee only. If you hear fee-based, ask for clarification. If you hear commission, run. Question 3. Do you earn commissions from insurance products, annuities, or mutual funds? The answer must be no for a true fee-only fiduciary. Question 4. Will you provide me with a written copy of your Form ADV? This is the SEC's required disclosure document. It will list any conflicts of interest, disciplinary history, and compensation structures. You can also look up any registered investment advisor for free on the SEC's Investment Advisor Public Disclosure (IAPD) website. Question 5. What is your investment philosophy? You want to hear low-cost index funds and evidence-based strategies, not market timing or active stock picking. Question 6. Are there any account minimums or minimum fees I need to be aware of? Some advisors won't work with clients who have less than $500,000 or $1 million. Others have monthly retainers that may be too high for smaller portfolios. Question 7. Can you provide references for clients with similar financial situations? A reputable advisor will be happy to do this. Step 4. Verify everything you've been told. Asterisk, use BrokerCheck, brokerchecktenra.org, to check if your advisor has any history as a stockbroker. If they do, they may not be a true fiduciary, since stockbrokers are held to a different standard. Review their ADV form on the SEC's Advisor Info site. This form tells you about their background, services, and conflicts of interest. If an advisor has a broker-dealer or insurance agent registration, they're likely not a fee-only fiduciary. Step 5. Understand the different fee structures. Fee-only advisors generally charge in one of 3 ways. Percentage of assets under management, AUM, is typically around 1% of the assets they manage for you annually. This is common but can become expensive as your portfolio grows. For a $500,000 portfolio, 1% is $5,000 per year. Highly fees range from $200 to $500 per hour. This is ideal if you need a one-time plan or occasional checkups. Flat fees or retainers range from $2,000 to $10, $0 per year depending on complexity, or $200 to $500 per month for ongoing planning. This model is becoming more popular because it aligns the advisor's incentive with your needs. They get paid the same regardless of what they recommend. Step 6. Beware of the free consultation trap. Many advisors offer a free initial consultation. That's fine, use it to interview them. But remember, if you're not paying for the advice, you're not the client. You're the product being sold to someone else who is paying the advisor. Step 7. Walk away if something feels wrong. Trust your gut. If an advisor pressures you, makes promises that sound too good to be true, or dismisses your questions, find someone else. There are thousands of ethical advisors who will treat you with respect. Part 7. The cost of bad advice, a cautionary tale. Let me bring this home with a real financial example. An entrepreneur with $5 million in investable assets paying an additional 0.5% per year in unnecessary fees from high-cost funds loses approximately $25,000 annually in direct costs. Over 20 years with compounding, that gap can exceed $700,000. That's not a hypothetical. That's a real person's retirement, a real person's legacy, a real person's financial security. Now imagine that same entrepreneur. Instead of working with a commission-based broker selling high-fee funds, works with a fee-only fiduciary who charges 1% but puts them in low-cost index funds with expense ratios under 0.10%. Over 20 years, the difference is nearly $1 million. That's not because the fiduciary is a genius. It's because they removed conflicts of interest and kept fees low. Part 8. Your action plan. Right now. Here's what you need to do after this video ends. First, if you currently work with a financial advisor, ask them the 7 questions I just gave you. Do not let them deflect. Get clear answers in writing. If they refuse to answer or give vague responses, consider that a red flag. Second, if you don't have an advisor but want one, start your search today using the resources I provided. NAPFA, XYPN, or Garrett Planning Network are excellent starting points. Third, if you prefer to manage your own money, understand that you don't need an advisor at all. A simple 3-fund portfolio of low-cost index funds, VTI, VXUS, BND, can serve you well without paying any advisor fees. I covered this in detail in Script 9. Watch that video. Fourth, if you have a simple financial situation and just want a checkup, consider an hourly fee-only advisor for a one-time plan. This can cost $2,000 to $5,000, far less than the cost of a bad commission-based advisor over time. Fifth, comment below, I checked my advisor today. Tell me one thing you learned. I'll reply to the first 50 comments. If this video saved you from a multi-thousand-dollar mistake, hit the like button. It helps others find advisors who actually work for them. Subscribe and turn on notifications. In the next video, I'm going to give you the ultimate retirement checklist for every age: 20s, 30s, 40s, 50s, and 60s. You won't want to miss that one. The financial industry is not designed to be transparent. It is designed to be profitable. The most profitable advisors are not always the best advisors for you. But now you have the vocabulary, the questions, and the tools to find the right one. Fee only. Fiduciary. Every time. I'll see you in the next video.